Today, our topic is the questions that people were kind enough to email to us, and we prepared them so that you'll find those answers helpful. They may even trigger some new questions that you might have. And if that's the case, wonderful. So here's the first question we're going to address today. Is what is the role of an attorney throughout the acquisition process? Let's take a look at what they do and what they should do, in fact, and what they shouldn't do. So the first obligation that they have is they're responsible for drafting and reviewing agreements. So whether it's your attorney as the buyer that's drafting the agreement with the seller attorney reviewing them or vice versa, their job is to make sure that the agreement reflects in legal language what the intent of the seller and the buyer are. And so you're going to want to dialogue with your attorney so he understands or she understands your intent, and that they will also dialogue with you regarding the trade-offs between business risk and protection. And the third item here is to give you as their client legal advice and options. In other words, to tell you what's legally possible, what's not legally possible, how to accomplish something legally, what something might need to say to do it legally. But here is the kicker for a lot of attorneys who think that they're somehow now experts on business. Their job is to absolutely abstain from giving you business advice. When it came to legal documentation, they went to school for several years to learn how to draft the documents, what the law says, what it has to say if it's going to protect you, the proper way to word the document. See, they've learned all that stuff, but they didn't get the degree in business operations or business buying and selling. That's not what they got their degree in. Okay, they weren't trained for those things. And probably if you've been in business any length of time, you probably have more experience there in the operations and all of that than they do. So you cannot count on them, and you shouldn't rely on them. When you get in a bad position with the other party's attorney is when the other party is accepting business advice from their attorney who doesn't know anything, and then it's problematic. The next question that we had, what is the CPA's role throughout the acquisition process? Okay, their job is to review the company's books and records that you're going to buy and validate their efficacy. So they're the experts on financial documentation and books and records. They're going to do, unless you curtail them from doing it, they'll also do for you what's called a search for hidden liabilities. In other words, there are tests that they can do on the financials of the information of the company that give clues to whether or not there are liabilities that the company has that have not been reported to you or they're not reported on their financial statement. Very important, because you don't want to buy a company only to find out it owes money you didn't know it owed. They're also going to advise on the company's financial condition. They know by reading the financial statements whether that company is financially healthy, whether it's got too many liabilities for its assets. See, they know all that stuff. They've been trained in how to read all those financial relationships and ratios. And so they can advise you on all of that. They can help set up appropriate books and records, accounting processes and controls post-acquisition. Because maybe the company you're buying doesn't have the greatest books and records in the world. Maybe they don't have accounting processes in place that give the owner a true insight on a real-time basis into the performance of the company. But when you run the business, you're going to want to have hired people to do some of these things, and you don't want them running off with your money, right? So there have to be controls in there that make sure that doesn't happen. They can help you with all that, okay? The one thing that they are not able to help you with is business advice. Accountants, frankly, are the worst business people on the planet. They are overly conservative, risk averse. They will not take risk for their own account, and they're unlikely to advise any business decision where they see any risk at all. So if you take your advice from them on business, you'll never do anything. You'll never make a profit. You'll never have a business that grows. You'll never have any of those things because they won't permit the risk or advise something positive when there's any risk involved in the growth of the business. Now, the next question that we had was, what happens at closing? Not a lot of people have ever had a closing. They had a lot of openings. The way most of these are done. The people don't actually show up anymore at a closing. So they'll start out with a set of escrow instructions that are signed off by the seller, by the buyer, and are usually prepared and negotiated through between your attorney and the attorney for the seller. So they'll come up with the escrow instructions that tell the escrow holder exactly what to do with every single piece of paper that they're going to get, and then what to do with that paper when they get it and how to close it out. Okay. So all those will be in the escrow instructions. There'll also be a documentation that comes in from perhaps a title insurance company, depending on what kind of property is involved, especially if you have lenders, they're going to definitely want all that stuff. All the agreements signed by all the parties come into the escrow holder. The cash from the buyer is put in an account held by the escrow holder. The funds from investors and lenders go into the account of the escrow holder. All that money's coming in because remember, that escrow holder is somebody everybody trusts. They're going to take in all of your transfer documents, all signed off, the titles all signed off. Everything that has to be signed off comes into them. The last aspect of what they do is there's a distribution of the documents to all the parties we're supposed to get originals and copies. And then there is an accounting of all the money that came in, all the expenses that were incurred, all of the distributions that were made to all of the various parties. It's reconciled so that everybody knows what came in and where it went out to. And then that's it. The accounts are closed. The documents are given to you. You end up with documents that are your titles that show you own everything. That's the agreement on how you got it, what you paid for it, all that. So it's all there. You got everything that you're supposed to get. And every party on this list here got what they're supposed to get. So that closes it out and everybody leaves and goes about their business from there with the new arrangements in place for ownership and operation. That's what a closing basically looks like. What questions should we be prepared to answer? Okay, when you're a buyer, you're going to get questions from a lot of folks. Who are these people that are going to want to ask you questions? You're going to get questions from a business broker. You're going to get questions from a seller. You're going to get questions from a lender who you want to loan you money to do this. You're going to get questions from an investor who you want to invest in your company that's going to purchase the seller's business. And the question they're all going to ask you is, how much money do you have to put down? Okay. And that's where normally most people would just sit there and go, aha. And that's not the answer you ever want to give. So the answer that you want to give to all those folks who ask you this question is, my partner and I can, and then whatever your number is, put down $500,000 or $750,000, whatever you've asserted or identified as what the down payment money is going to be. And the reason you always want to assert your partner in you is because at the end of the day, the reason you would have been hesitating to answer this question is we're going to assume that you don't have any money to put down, or maybe you have some, but it's not much and it's not near enough. But the key is you also know Bizar financing, right? That we have ways that if you've studied all of our material, you're not going to have to put down money of your own. It's going to come from other people, but nobody wants to hear that. Okay. Because if the business broker hears anything like you don't have money to put down, he'll ignore you because he earns a commission and it has to come out of the money you put down or that somebody puts into that escrow into the down payment column. The seller wants to know because he wants to know if you're real. Same thing as the business broker. The lender wants to know because they don't want to have more skin in the game than you do. They want you to have your money in at a certain level so that you lose your money ahead of them if things go wrong, which is your incentive to never let that happen. And that's also true from an investor as well. So the first thing you have to learn to do is to finesse the question of how much money do you have to put down? So one of the things you want to learn to do in this process is to preempt the business broker from asking you to see a copy of your financial statement or from even asking you how much money you have to put down. So I will tell you categorically, in the last 50 years, not a single business broker, not a single seller, not a single investment banker, not a single lender, not a single borrower, not a single investor, nobody has asked me those two questions. How much money do I have to put down? And let me see a copy of your financial statement. And the reason for it is I preempt that in the way I present myself to them. I present myself in such a way where they presume I'm a qualified buyer and they give me everything I need. So I'm 99.99% positive that if you review the video on my first purchase, that whole essentials video, you'll see exactly how to finesse those two questions, financial statements and how much money do you have to put down, which are the key questions they all ask you. Okay. You'll see how I did it and how you can too. Okay. Here's a statement before a question. He says, I've been looking at businesses on Biz Buy Sell and noticed some businesses are selling without the inventory and would have to be bought separately, meaning the inventory. Is this common? And the answer is no, it's not common. If the inventory is not part of the sale of the business, how can you evaluate the business? First of all, you can't. Okay. And I'll tell you why you can't. If the inventory does not either come with the business, or if when you add the inventory cost to what they're asking for the business, that it doesn't make sense, simply pass on the deal. Okay. And the reason is if the inventory is not going to be sold to you, you are not buying a going business. You're buying a startup. Why? Because you can't be in business without the inventory to sell, and you've got to have inventory to sell on the day you take over the business. Otherwise, you're out of business, right? Until you get more inventory. So if you have to go get more inventory produced, or you have to buy it from a source that's going to take 30 to 60 days to deliver it to you, that's a period of time you're not in business. What are your customers of that business doing? They're not going to sit around and wait 60 days to get their product. So they're going to go elsewhere for it, and you've lost them as customers. So all of the goodwill of a business literally disappears if it doesn't come with the inventory, because it means you're out of business till you replace it. Okay. So don't even think about buying a company without its inventory, because you're literally buying a startup. And all the goodwill value that they're trying to charge you for is lost, because they're showing you how much money they've earned in the past with the business. And they're saying, you buy this business, you're going to earn that income, right? You can't do it if it doesn't come with the inventory. So hopefully that part is really clear. If the company has no assets but has cash flow, is it still a deal to go after? And here they refer to perhaps a janitorial commercial cleaning company, for example. So here's what they're telling you, okay, that the business has cash flow because there's a guy who sits in a closet and he takes orders for janitorial supplies or commercial cleaning, and then he outsources it to somebody else. And the whole activity is done on the phone because the business has no assets. Even there, I assume he's applying that it's a home business, right? So when you buy the business, you don't need any assets because you're going to have your own desk, your own chair, your own phone, your own internet connection, all of the stuff you need to do the business. But now you're going to do it at a closet in your house, right? So if a business has no assets but has cash flow, that's not a good business to go after, because basically what you're buying is not a business, it's a job, right? As long as you're in your closet doing your job, the business will bring in money. But then you're a slave to the business, because if you go on vacation, there's nobody there to do it for you. So it makes no sense to look at a business that has no assets, but has cash flow, but the cash flow is being generated really by the owner. Okay. That's called a job. All right. And maybe it's a good income job, but it's still a job. And you have no leverage there. Okay. You can't grow the business. It's not scalable. All right. So you can't, I say, maybe I can hire somebody, but in order to hire somebody, you got to have capital. You got to have cash. Anything you do to grow a business requires capital to grow it. But the important point that I'm trying to get to here is you can't buy a business without its inventory. Its inventory doesn't come with it. And if the price of the inventory doesn't fit well in the price of the total company, so that you can make money based on the amount of purchase price that you're having to come up with, then it's not a good business for you to buy. All right. How is government policy affecting business acquisition? That's an incredibly good question. Government policy is affecting business acquisition badly for small businesses. Why? Because the whole economic system is turned on its head right now against small business in favor of big business. You look at every policy that exists in government today, its regulation, its tax structure, all falls heavy on the small business and handleable by the big business. All right. And so if you're acquiring small businesses, that's a problem. That's why I'm not acquiring small businesses. If you look at the companies that I'm acquiring right now, the one we have a meeting on later today, the company has a transaction value of $750 million. Okay. It does 800 and some odd $1 million in revenue. Its EBITDA is around 65 million a year in EBITDA. And yeah, it's a big business, but boy, it's a whole lot easier to raise money for that company than it would be to raise money for a company doing a couple of $1 million a year in sales and making a few $100,000 a year in profit. And that's for two reasons. Okay. One is you can't get anybody, lender or investor, excited about investigating a company that I want to buy, only to find out they can't make any money on it because the deal's too small. Okay. The bigger the deal, the more excited everybody gets, the bigger the people you can attract into the deal, the more hunger you can create in all those people to be part of the transaction, because you got a company making a ton of money. All right. Compare that to a little company, it's making a little bit of money, nobody's getting excited, very hard to do. Then when you acquire the small business, you got very little resources in the company to handle the government regulation, to handle the high interest rates, to handle all of the things that company has to deal with. In fact, the questions even get easier. For example, on a small deal, everybody wants you to guarantee your loan, right? So they loan you the money, but they want your personal guarantee. You want to establish credit with a new supplier, they want your personal guarantee. It's a nightmare. Okay. Whereas if you're buying companies, we do $500 million now, what are called mezzanine loans, and they don't even think about asking you for a personal guarantee. It's not, it's unheard of. They don't do it. So all my debts are not personally guaranteed. Why? Because they're of a size and in a sophisticated enough marketplace, meaning the lenders are sophisticated. And everybody plays the game where they assume the risk that's appropriate to their particular loan or investment. And there's an interest rate that's they charge for that. But think about this. Suppose you're buying a company where somebody's going to loan you $1 million. Look at the vetting that they have to do to decide that you're okay for that loan. Look at the amount of profit they can make on this $1 million loan. It's small. Okay. Their margins have to be big. They have to charge you a lot of interest at a high rate in order to make any money on you. Whereas on a big loan, $500 million loan, they can work on very narrow margins and make a ton of money because the loan is so big. All right. So bringing it back to the question is, how is government policy affecting business acquisition? Very bad, because the interest rates are high. Okay. The regulations are imposing. Okay. And everything has been done to make small deals nearly impossible relative to bigger deals. So it's a policy oriented totally towards big business. So the deal that I'm trying to express to you is, if you're going to get into business acquisition, raise your sights a little bit. Look at how you can get into bigger deals as opposed to struggling with smaller deals. And I just want to say this. The reason people want to struggle with the small deals is because they don't think they deserve the big deals. That's for the big guys. That's for the elite. That's for whomever, not them. And it's not true. That's why Bizar Financing is this key facilitator for you, because we show you all the secrets. There was another question that came in the same vein. It said, government flooding the economy with liquidity, i.e. cash, how to use it in acquiring a business and how to access it. I think what this person meant by this is that the government is either spending tons of money or has been spending tons of money, putting all this money into the economy, which has now caused inflation. But the money is out there, the liquidity is out there, but how do you get it? And how do you get it into your business? How do you access it? Okay, you access it in the same ways that it's always accessed. There are lenders out there flush with cash. They're called banks, insurance companies, pension funds. Okay, they love to loan money. They love the new higher interest rates. They love putting that money out, but you got to give them a business plan, right? So how do you access it? You go to a mortgage broker to get access to insurance companies and pension funds. You go to investment bankers who have access to investors and all kinds of other lenders that they can bring you into. But when you go to them, you can't go to them naked, right? You can't go to them and say, I'd like to borrow a lot of money, or I want you to invest a lot of money, because no one will pay you any attention. Okay. So what do? You have what's called a CIM, which is a confidential information memorandum, or you have an executive summary or a business plan, or you have any one of a number of different things that show them what you're going to do that's going to produce so much profit that you can easily give them a phenomenal return on their investment, or pay their high interest rate and do it comfortably, where your cash flow on a pro forma basis going forward, taking your history and then take of the company and then projecting it forward, you're going to show them how you're going to be able to give them their money back, plus a very high return in either interest or equity participation. And you've got to be able to put that together. Okay. You've got to be able to do it. In Bizar Financing Pro, we show you exactly how to do it. There's chapters on it, on each one of those. And there are tools that are in there that help you to figure it all out and to be able to show it to all the different parties that you have to show it to. And the objective is for you to put together an executive summary that section by section tells the investor, tells the lender, everything they got to know in how in loaning or investing the money in you, their money is relatively safe, relatively low risk, and high rate of return, and how the resources are there that give them the comfort that this business can do what you're projecting it will do, who the management is, why they're qualified. Okay. All of these things are important. Now, if you're buying this little tiny business, who's qualified? Probably nobody. The people who are qualified are probably leaving because they're the seller. So then there's you. How do you prove you're qualified? I never worry about proving I'm qualified because I buy a business big enough to attract top management talent. Okay. So I find out who top management is. I show them how I'm going to give them a piece of equity in the deal. If they're part of the company already, I show how they're going to love staying on with me as their partner because I'm going to give them an equity in the equity interest in the business. But you got the proven management talent there to do it. And if I don't have the management talent in the business, I'll research the hell out of the marketplace, find top people in the industry, and give them an incentive to come be my minority partner in my purchase. I'll give them a big piece of equity in the deal. And they don't have that where they are right now, but their management skills and talent and resume is superlative. So now I can prove to my lenders and investors that I'm going to be able to give them a very pleasant experience loaning or investing the money into me and my company that I'm about to acquire. So yeah, the liquidity is out there. It's all over the place, but it's not available to you unless you go at it in the right way. But once you know how to go at it in the right way and you pull together all those pieces and you present it to the parties that have access to the money, and they don't hide, by the way, they're out there. In fact, if you go into your Bizar financing website, you go to the research center there, you'll find that there are links there to every single type of entity that is there to finance your type of business. And it'll take you right to their websites. Okay. You'll see exactly what they do. And it's all by category from every type of lender and investor that there is. There's a section there and you don't need to be part of Pro to get that. You have access to that through Essentials. So all that is right there for you and you can go to it there. How to get that cash given to others into the business you're buying? I guess I really just answered that question. You've got to show them what you got. And you do it through certain types of documents, whether it's an executive summary, a business plan, a CI. We even have designed our letters of intent to a seller where we're telling them now what we're going to do, the terms of the transaction, everything. We have an introduction that lays it out, who we are, what we do, why we're the best people on the planet for them to sell their company. It's all the first page of the letter of intent. But you remember, you think you're buying businesses, but you're really selling yourself. You're selling your ability and your team's ability that you've put together to do this. You're selling the ability of your group and to pull off this acquisition and that you have either in the company already or part of your group, the management capability that proves how to run it competently, right? And that you've aligned all of your business purchase elements to give them a high return with limit or no risk. Now here it says how Fed quantitative easing is an ally to the leverage buyout buyer. Okay. Now it's an interesting question because they're not doing quantitative easing anymore, but they're doing the reverse. But let's just take a look at something. A lot of times people will ask a question and it's because they don't fully understand all the terms that are involved and what those terms really mean. So no matter how sophisticated I've ever gotten myself, I'm a big user of Google. Okay. I'm a big user of the internet to go research any term or anything that I'm not 100% sure about. Okay. So when I go on to a search engine like Google and I put in quantitative easing up in amongst their responses to my query, they'll refer me to websites. And here's one website that they referred me to. And if I go into that, it comes up with an explanation of what quantitative easing is. And then it will also give me some understanding of what it is, how it works, and all of that. So let's just take a quick look at what quantitative easing is. Quantitative easing is a form of monetary policy in which a central bank, like the U.S. Federal Reserve, purchases securities from the open market to reduce interest rates and increase the money supply. Quantitative easing creates new bank reserves, so your bank has more money to put out in loans, providing banks with more liquidity, i.e. the cash to make loans, and encouraging lending and investment. Okay, in the United States, the Federal Reserve implements quantitative easing policy. Right now, that's not what the central bank is doing right now. What the central bank is doing right now is they're raising interest rates to make borrowing less attractive and harder for you to use borrowed money to buy anything, including a company. So right now, it's not quantitative easing that's happening. It's increasing in the interest rates, which are making businesses less valuable. All right. And think of it this way. Okay. You got money to put into some kind of an investment. You want to get some kind of a return. If you can put money into government securities and make 3, 4, 5% on your money, you can put some money into investments in the into federal debt instruments in low amounts, but where you can earn 2 or 3 points over the rate of inflation. So those are paying 9, 10% right now. Okay. But you can't do a lot of that. There's limit to how much they'll let you do of that. The point is that the higher the return you can get on money you put into safe government investments, the less likely you're going to be investing that money into businesses where the values, if you look at the marketplace, the stock market, those values are going down. So why would you be investing in businesses whose values are going down where you can invest it in a safe investment where you're going to get a decent return on your money? Okay. So the higher the Fed cranks up the interest rate, the more that becomes true, the lower the value of businesses, the lower the value of the stock market, and the less likely that people will want to invest in a business when they can put the money in something safe and still earn a decent return. So as long as they're keeping to hiking interest rates, the values of businesses are going to come down. Okay. But it's going to be more expensive to buy them because if you're using borrowed money to buy them, your interest costs are going up. However, this is a great time to be buying businesses. And the reason is because as the interest rates go up, it costs you less to buy the business. If I buy a business today at high interest rates, the cost is about the same to me as it would have been had I bought the company when it was low interest rates, but the price was higher. But guess what? When I buy it when the price is low, that's forever. And so a year or two from now, when interest rates come down again, I can refinance and I bought the business at a bargain and my interest rates are fine for the value that I paid for the business. Okay. Because I refinanced when the rates come down, as opposed to if I bought it when the cost was higher and the interest rates were lower, I can't refinance it. Right. Because if I refinance it now, I pay higher interest rates. Okay. And when the rates come back down, I don't have to refinance it. I already got a low interest rate. So I didn't accomplish anything. Okay. When the business price was high, except pay a high price for the business. But if I can buy now, I can buy at a low price and then refinance when the interest costs come down. It's a heck of a lot better deal when I buy now. When I go back to the original question of quantitative easing, when that was the case and it was quantitative easing, what was happening is that the marketplace was being flooded with liquidity. So I had all these folks out there when interest rates were low that wanted to loan me lots of money to go buy the businesses. All right. And so if we ever have quantitative easing again, which I don't see happening for the next 10 or 20 years, but when it happens again, and it's sometime in the long-term future, it will, then that's the time that I want to go buy businesses like crazy because I'm going to have low interest rates and a flood of money out there looking for something to do. So it gives me the opportunity to do this productively. But for the people who understand what's really happening right now, I'm going to go out, I'm going to buy the business at a low price. I'm going to borrow the money at a high price. I'm going to make sure that the cash flows will sustain the business through this period. Okay. That I want to make sure that the cash flows are going to be adequate, enough profit in the business. But then I've got a hell of a bargain once the interest rates come down again, whether it takes a year, 2 years, 3 years, 4 years. At some point, that interest rate's going to come back down again. And when it does, I'm going to refinance. And now I got myself a hell of a bargain that I paid for the business. So that's the nature of where we are. So hopefully that helps everybody to understand that process, including when you have any question about what something really is, go do your Google search, find the right website, go in and get your information, and you'll make better decisions when you use that process. Says, why can heavy borrowing now be smart money management? I guess I just explained that. Borrow money now, you pay a high interest rate, but business values are low now because of the high interest rates. And so you're able to make a bargain purchase of the business at today's pricing. And then when interest rates come down, you are refinancing at that higher rate.